Well, copper plunged, gold wobbled, and the Fed held rates steady this week, signaling caution on inflation and no rush to cut. At the same time, President Donald Trump's proposed tariffs shocked copper markets, missing investor expectations. Well, joining us now to unpack what it all means for metals and the macro outlook is Mike McGlone, Senior Commodity Strategist at Bloomberg Intelligence. Mike, thanks very much indeed for talking to us.
Thanks for having me, Devan.
Well, let's start with the Federal Reserve, right? Rates were held steady, but Jerome Powell signaled no urgency to cut. How has that shaped commodity market sentiment this week?
It was expected. The way I look at when you think of Fed and commodities, I start with gold. And I think gold, being one of the best performing major assets this year in terms of US dollars, is figuring out the silliness of markets and the president calling for the Fed to ease with the stock market on a tear and inflation above targets. It's just kind of silly. In my old days, I guess let's pull 60-year-old, curmudgeon, 40 years in the market. That's not an environment to ease, it's an environment to tighten. But to me, that's what gold likes. Everything else, it's a bit of a problem for commodities. You saw what happened with copper this week. But overall, the Feds shouldn't really ease, I think, until the stock market goes down and tells them to.
Yeah, that's a sentiment coming through. Well, you touched on copper. Copper took a hit after Trump's tariff announcement excluded raw materials like cathodes and ores. Why did this move rattle the market, Mike? I mean, and does it reflect political signaling or miscalculation? What's your take?
I think the answer is yes. The key thing to think about from copper is, with respect for our viewers and listeners who are traders and actually run risk. I used to. I just say it now. I don't do it anymore. It's a great market to. I really respect people who did well in copper this year. I think I probably would have lost money trading it. But the significance of what's happened in copper is let's look forward to what it means for us. Everybody knows what's happened. U.S. said they're going to have tariffs and then not really having tariffs on the actual copper that the futures track, which is the refined copper. Is copper's pump this year to the high of $4.96 a pound just this month was very much akin to July 17 years ago in 2008 in crude oil. When crude oil pumped up to 147, that's the all-time high. We're still 50% below that level. It's the highest ever. To me, there's inklings there. It might be the same thing because of the reasons it did it. Now, these tariffs are very abnormal. The spread between U.S. traded CME copper and LME copper at 30% just a few days ago reached the highest ever. And now it's back at parity. And typically the way these things work in commodities, when you get way too extreme to one way, you always go extreme the other way. Yet copper has a normal tendency to autocorrelate towards $3 a pound. Right now it's $3.35 a pound, which is the same as the U.S. 10-year note at $3.35. It's $4.35 a pound, which is the same as the U.S. 10-year note at $4.35%. And to me, the risks is both of those go down. So I'm putting out a note tomorrow when this hits the tape that I think copper's got risk of going to 3. It always has. And what stops it? What are the key indications for that to happen? Well, iron ore is about equivalent levels. If you go back as far as we can track iron ore and the trades in China. And Chinese government bond yields are at levels that indicate that we should see copper drop to $3. 10-year note yield in China is 1.71%. I mean, that's deflationary forces. Very much akin to Japan 30 years ago. So I see copper at risk of doing what it should do, and in a world that's facing tariffs from the world's most significant goods importer. And as we see what's happening in China, the more significant demand pull source for copper is China's heading towards deflation if you look at their bond yields.
Yeah. Listen, Mike, gold's been treading water, right? I mean, with sticky inflation and firm real yields, do you see or still see it outperforming other risk-off assets like a Bitcoin, for example?
Oh, sure. I think the key thing for gold is right now about 3,300 an ounce. It's basically called a bull flag for about 4 months. It's just waiting for its next move. I don't see it sustaining below 3,000. It could correct there if we have a major uptick in U.S. stock market and uptick in U.S. bond yields. I think it's just a matter of time. It makes a new high in the air above 3,500 and gets to 4,000. A key catalyst for gold to really break out, stay higher, is a little bit of volatility picking up, a little bit of normal correction in U.S. stock market. Remember, we're in that low volatility time of year, peak summer, just as we head towards the volatility time of year. If that stock market goes down, that's the next catalyst for gold. And I think that's what's happening. I just put out my latest outlook. If you take the price of gold divided by the S&P 500, it's ticking up. That ratio right now in terms of ounces, gold ounces is 0.52. If we end the year here, it's the highest since 2015. I'm talking end of the year. We only have a few months, 5 months left for that. At the same time, gold ETF holdings have jumped. We've had 4 years of outflows in gold ETF holdings. They've jumped up about 10% this year. I just got off a call with the World Gold Council today, and which is the end of July 31st, and they point out they're really not seeing that typical responsive supply elasticity in recycling, and supplies not coming on yet. Demand's very strong, although yeah, central banks have curtailed some of their buying, but gold to me is a decent bull market that's just consolidated for a few months and just waiting for the next breakout. The key thing I want to remember about gold is I'm really concerned that what it means when it does break about, I should say if, above $3,500 an ounce, because that means the rock is still beating stocks. And the stock market, the key thing is that gold versus a flat S&P 500, if you don't include earnings, is the same for almost 10 years now. You don't hear that when you talk about, people talk about the AI-driven stock market. So I'm still bullish gold, and I think gold's anticipating what's happening with how expensive the U.S. stock market, the silliness of the repercussions of President Trump pushing back on Fed independence, and gold's in a win-win situation. I just don't know what's going to take to really break down. I mean, it can correct, but to sustain lower would be a wonderful sign. It means the stock market continue, but I fully expect the rock to continue beating stocks. The big thing for the end of this year, Devan, is if the stock market drops, then that's, I think, big fuel for normal deflation on a global basis, which has already happened in China, and it's pretty significant rocket fuel for gold.
Yeah. Mike, listen, you often said, and I've read this before, buy when they are crying. Where do you see the smartest contrarian bets in commodities right now?
Yeah, I think there's some and there's buying when, well, I just piggyback on what, it's an old phrase. Buying when you should be buying when they're crying, selling when you yell. Now, to start with, I really brought that up because I think what's happening right now in cryptos, in Bitcoin, is the classic sign is you should be selling when they're yelling, because it's a classic pile on trade. And cryptos, and so not only Bitcoin, is very expensive, although it's been running flat versus gold for 4 years now. Okay, I mean, it trades 3 times the volatility of gold, and yet this store value is outperforming it. I mean, that's not a good sign. So to me, that's a selling when you're supposed to be yelling market. And I think that's going to be the indication for all risk assets. To me, the amount of a systematic risk in Bitcoin now is inordinate. I can't get bullish it, because if it goes down, just a normal correction of 50%, it takes everything with it. Most notably the stock market. I mean, people jump in treasuries now, which is a good bullish factor for gold. Yeah. As far as commodities, we're getting towards low price cures in the grains. It's August. You look at corn, front corn is running around $3.93 a bushel. The break-even cost is around $3.75. Typically, you have to get below that break-even cost in the Corn Belt for a bottom. Last year, we bottomed around price. I think we're going to put in a pretty enduring bottom this year, but it's a bear market that's looking for a low price cure. The one market that's still doing that, looking for a low price cure, I think, is crude oil, still probably heading to that U.S. break-even cost around $55 a barrel. And now also we're seeing what's happening in copper. That spike is probably going to make that part of that downward trajectory. So you see that almost all commodities have risks of going lower, most notably if the U.S. stock market rolls over a little bit, and the key commodity that's outperforming and going up is gold.
Okay. Now, Mike, as we wrap up, because time is against us, but I want to get your word on this. You can't speak about this without mentioning China. China's PMI dipping again, and copper's been sliding. Are we looking at a broader demand slowdown here in industrial metals as we wrap up?
Oh, sure. Well, let's look at copper. Copper in London traded at $9,600 a ton at the moment. It's the highest close ever on a year-end basis was 9,800. 2021 is the last time. I think it's risk of going back down to 8,000. Look at the Bloomberg Industrial Metals Index on the year. It's up 1%, despite the stock market up 10%. And the U.S. dollar index down 7%. That's a real bad sign. So I view the risks for industrial metals, most notably copper, is downward. Iron ore is having a problem, and it can't get above $100 a ton. And then you just look for catalysts, just more of the same. But the key thing is you basically need that stock market to go up now for these highly economic sensitive commodities like crude oil and industrial metals just to stabilize. What if the U.S. stock market just has a little bit of a back and fill? That's the deflation that typically follows inflation, which I think we're way overdue for. So I think the rest of this year is going to be quite significant, particularly if the U.S. stock market goes down. It's going to take the dominoes tumbling, and it's just going to follow what's happening in China in terms of bond yields.
All right, well, some compelling insights there. Thanks very much indeed, Mike McGlone, Senior Commodity Strategist, at Bloomberg Intelligence. Mike, thanks very much indeed for your time.
It's my honor, Devin. Thank you for having me.